Setting it up. The webinar is being live streamed. All right, I think we are rolling. Let me go ahead and share this link with the team so they know where the YouTube is going, and I think we are good. All right, thank you for bearing with me through that. So, a couple things to cover today. I'm sure many of you were on our 11:30 session as well. I covered a lot of kind of high level ground there. I'll cover some of that here as well. Go through that. Talk about a couple opportunities that I think are short term, medium term as well. And then if you guys have questions, you have things you want to look at, I'm always happy to do that as well. So let me go ahead and share my screen and we will get rolling. Okay, so the first thing I want to do is I want to look at the good old S&P 500. Here's the SPY. Now, the big takeaway for me here on the SPY is essentially that our no man's land range has kind of expanded out. So before we had a tighter range in the S&P where we were looking for a break to all-time highs or really anything below the bottom of this range. So say anything below 580 to get some direction. Now, the problem is we pretty much got the weekly close to the downside that we were expecting. And I was very close to getting heavily on the short side as of the end of last week. But we kind of immediately pivoted back up above this key zone. So if I just zoom up in here, this zone has now kind of all become no man's land, where before we were looking at something like this, more like this, where anything above this bias to the upside, anything kind of close and confirmation below this, bias to the downside. But we got a really nice week last week. And as you can see, immediately rejected. So what I think is happening here is we are expanding this no man's land out a little bit wider, where now you could even see it, even if we got a full rejection, it kind of brings the rest of this area into no man's land. And we really need to get a move below 560 on the SPY, and then we might target over here these previous highs in the 525 range. And if we get a break to all-time highs, of course, that gives you a pretty strong bias of continuation to all-time highs. So that's the first thing that I think is important to note is just the range of kind of how we've widened out this no man's land. Now, I did mention earlier, QQQ is in a very similar, that's the NASDAQ, a very similar situation. The only thing that's different is that because the range just was structured a little bit differently, it never got quite as high on all-time highs, but then it also didn't correct quite as deep. So relative to this July 8th high, we're actually much lower on the QQQ than we are on the SPY. The SPY has still plenty of room between this July high and the current, this week's low, whereas the QQQ is already kind of sitting on that. So I mentioned you could take that in two different ways. Number one, you could say, well, the QQQ is weaker, tech heavy, it's high flying, it's weaker, so it has the potential to correct more deeply and maybe head back into these March highs or something like that. Or you could take the exact opposite view and say, well, the Qs have a deeper correction relative to where they've been, more support at the bottom of the zone, and now they have upside. And I think I actually like QQQs for some initial upside. If you guys have heard me talking recently, I think there's a decent chance that we get some of that infused optimism from the Trump inauguration, kind of a second wave of the election. The question, of course, is just how much of that is already priced in when you see a big week like this. You have a week where the SPY's up big 6%, and you say, okay, well, how much of that optimism is there but already priced in, where now we're going to look for more of a correction and a centering out of next week. So there's definitely a legitimate argument there, but I still like the idea of where the QQ sat and has the potential to move up. And if you look at the week as a whole, what you get is something very, very different. So if you look at the actual sectors this week, all right, so here's our sectors this week. Okay, notice strongest sector, basic materials, obviously has a lot to do with California and all that kind of stuff. Financials, real estate, energy, industrials, consumer, utilities, And then tech, all the way down here is tech, this light blue line. So you can see what's very interesting about the movement that we got in the massive upside in the SPY, because the SPY is up like 6% this week. It's not the traditional thing that we've grown accustomed to the last 2 years, where when the SPY's having a big week, you just look, okay, so tech must be up twice as much as the broad market. It's pulling everything up. Actually, no. We've got a very interesting week here where other sectors are driving this wider baseline move. Basic materials, financial, industrials, energy as well, which have been kind of undervalued. Now, if you look at that on the price chart, it's really kind of jaw dropping in terms of uh, relative breakout. So, again, the SPY here, big candle on the SPY, right? I mean, really, really big bullish move here, but not crazy relative to how the SPY moves. We have lots of big bullish candles, lots of big bearish candles, a lot of these breakouts. I mean, the same would be true with the QQQ, same kind of thing, big candle, but we see lots of big candles. I mean, look at how the QQs move. Now compare that to something like XLB, Basic Materials. I mean, Basic Materials has had almost no bullish weeks that compare to this one. Go ahead and look at industrial, same kind of thing. Relative to this move, I mean, there's a couple in here, but this is a big breakout move. Energy, same kind of thing. Energy's had some big bearish moves. I mean, you can see the difference between this and a lot of these other ones. XLU, which is maybe my favorite right now because it has this beautiful XLU has this beautiful bounce off of these key 74, 75 level here. If you just draw a line, you got to see where this is. 1, 2, 3, 4, 5 weeks in a row that have come off this 75 area and then made a breakout. I like XLU quite a bit. It's one we'll probably end up trading in our live automated options class here in about 20 minutes. We might trade several of these. But my point being, there's a lot of movement here. XLF is another one, just a big old breakout candle here on XLF as well that is driving the broad market. So if you think about it from just a very kind of pragmatic macro standpoint, what you get is a back and forth volatility filled market where these sectors have kind of been intertwined. One's up, one's down. Bitcoin's leading with really high risk on. Then it's correcting 12% in a single week. And then all of a sudden, out of nowhere, we get this week where almost every sector is aligned, and not just every sector being aligned, but kind of the base rotational sectors like industrials and energy and basic materials are actually driving more of the net movement than tech or any of the other high flying instruments. So it's like this weird, really healthy bullish week out of nowhere because the market's been so chaotic. And the last 20, I mean, I was just on the phone with Tom Busby talking about this. The last 20 days have been some of the more chaotic markets we've ever seen because you're getting such clear momentum in both directions all the time, switching back and forth, risk on, risk off, risk on. Gold, sometimes aligning with the market, sometimes going opposite. So it's been really bizarre. And then all of a sudden, out of nowhere, you get this really healthy looking week where almost all of the sectors are aligned. So to me, I think that does give us the potential that we could see some continued optimism for a little while here. I think I would put that more on the short term analysis. So if you're writing down tickers for the short term, I really like trading some of the direct momentum on the sectors themselves. So trading things like XLF, XLB, XLI, XLE, a lot of those trading them directly, I think are interesting plays. I shared earlier, I still like Progressive. Progressive started picking back up this week after pretty heavy correction, at least by Progressive standards. If you scroll back and look at Progressive, you're not going to see a ton of big corrections like this. From 270 down to the 225 range, you're talking about pretty significant correction. You're not going to see a ton of those. This is just such a beastly stable stock. So, whoops, grabbed a line there. So I really like Progressive here as a potential rebound. It might, with some of the California pressure, although like I said before, I don't think that Progressive is actually that exposed to the California downside, but you might get a little extra squeeze here. But I think you're already near the bottom of any expected correction for something like Progressive. So that's a stock I like. Similarly, a corrective stock I like is Apple. Apple obviously really weak right now, especially relative. I mean, if you were to compare it to just the Mag 7 directly, this is the Mag 7. Okay, so let's just scroll in here for the last little Bit. Okay. So just, for the last 6 months, you can see how much the Mag 7 has outperformed Apple. If you just go literally 1 month, whoops, sorry, just go 1 month and then zoom into the start of 2025. There we go. The start of 2025. As a whole, the mags are up 3%, which is pretty wild that they're up 3% given how ugly some of those corrections were. And then Apple's down 5%. That's a 5.5, that's a 9% divergence between Apple and the Mag 7, keeping in mind the Mag 7 is heavily weighted with Apple itself. So the fact that they have a 9% divergence so far is insane. But that shows you how relatively weak Apple has been. And so for me, Apple's a stock that I have about as much confidence in anything on buying dips. I'm not a big buyer of dips. It's not typically my strategy. Those of you who follow me probably know that. But Apple is one that I have more confidence than almost any other, being willing to buy a dip, take a little bit of heat, even if it goes lower, and just plan on rolling or holding on for a longer term. Now, there's three reasons I like Apple, particular to the AI race, which I talked about earlier. One is that they have so much cash and capital and now will be under a more acquisition friendly environment with Trump in office, that they will likely try to acquire or continue, because they already have continued to acquire AI, whether it's research, and development kind of acquisitions, or if it's literally just, separate, monetization revenue output businesses. Either one, probably both. They'll continue to look to acquire. And they have so much cash that they're able to do that. Number two, they also have so much cash and such a heavy team. They have like 10 times as many employees as Nvidia, that they're going to put a lot of research and development and try to, develop AI advantages to help streamline and enhance their business. And they do have so much staff and so much overhead that, something like a 20% increase in their margins is billions and billions and billions of dollars for a company like Apple. And they will certainly be pursuing that with AI development. And the third thing, and my favorite thing about Apple, is let's say they crap the bed on AI, they don't develop anything amazing, they don't acquire anyone amazing, they still are going to sell tools, meaning Apple iPhones, iPads, AirPods, and everything else, that are still going to use other people's AI enhancements, and everyone's still going to want to buy them. So whether Apple develops the AI or not, millions and millions of people are still going to buy the AI infused iPhone. And so I think they're much more protected from the AI kind of bubble feeling than almost every other major tech stock. So there's lots of things about Apple that I like fundamentally. Technically, I think it's kind of oversold right now, which is not a term I really ever use other than maybe like a juggernaut stock like Apple, Progressive, AJG, stocks like that. And so I think this is a really interesting one that I started buying up a little bit more aggressively last week. Of course, I'm down since then, but willing to kind of keep buying and keep rolling over because I like Apple quite a bit. Meta is an interesting one as well. Sticking with the Mag 7s, obviously a lot healthier than Apple has been, really consistently healthy. I mean, I think outside of Tesla having some really kind of crazy outsized moves, Meta's probably been the healthiest Mag 7 stock since Nvidia started slowing down, which was a month after their split or so. Since they started slowing down, I think Meta has been the healthiest of the Mag 7. And I would argue they actually still have the most upside as well. They're not, a trillion market cap. And then, of course, they have the interesting catalyst where if TikTok actually was shut down, Meta and Google, because of YouTube, so Meta and Google probably stand to benefit the most if that were to happen with TikTok. So just some interesting things there. But in general, I like the Mag 7. And particularly, I like the idea of being able to trade the Mag 7 while still feeling confident about things like energy and gold. Because I think right now you can kind of get a nice balance of go ahead and trade this, kind of tech melt up move, see if it goes on to the next generation of stocks, which I think it will, at least for the short term, but not be totally tech reliant, because you can still confidently trade some things like energy when it's breaking out, utilities, and then gold. So you can kind of have your cake and eat it too, where you're trying to tap into the big tech stocks and some of the kind of outsized momentum there, while also trading some safer, more market, kind of risk off assets. Speaking of gold, still like gold quite a bit. Here's the gold chart. I think had a nice little correction here, exactly what you want to see. Not an overcorrection, not a slow steady trend, just a very small, in terms of percentage correction for gold, similar to the one we saw in May. Not kind of like the long, 8-month correction we've seen in the past. And so I like gold. It's not it's not ever one that I'm going to trade like as a momentum outsized return. But I like holding it. I like the fact that I can trade debit spreads on it and still make 100% on a small move in gold without having a ton of capital. So GLD continues to be one that's consistently in my wheelhouse. The last one I want to mention, just as far as particular tickers, is IWM. So this is small caps. IWM for me is still one that I'm kind of waiting to bloom. I've been holding IWM since all the way back here when it broke out at the beginning of last year. So I underperforming so far by my expectations, but still just kind of waiting for it to fully get on a roll and gain some momentum. And so this is another one that I think the Trump thing could come into play. If people believe that there's going to be deregulation, there's going to be less regulation and less taxes on the smaller corporations, that they can compete more actively. Maybe that becomes a big tailwind. You can kind of stretch out this level that was here before and see that we're trying to maybe get back above that, where we could take a crack back in the low 240s here on IWM. But this is another one that I'm just kind of painfully watching, waiting. It's like some of the energy stuff. I don't hold a ton of energy, but I hold a decent amount for the dividends, and just watching it kind of grind and say, okay, can we get a big tailwind at some point here? And for the last year, I think pretty dramatically underperforming. I mean, if you just look at, for example, the Qs, and we just go and do the 1 year, IWM up 19%, Qs up 28%. That includes the fact that the Qs just had like an 8% correction. And so historically, when you expect, small caps to actually outperform mega caps, and in just 1 year, they're down net 10%, it just feels like there's got to be a catch up here at some point. I've been trading that catch up for a while. So far, haven't really got it. If you go back, by the way, and do 5 years, this gap gets insane. I mean, IWM is only up 36% in the last 5 years, while the Qs have outperformed 133%. So just a major gap there that I would expect to get filled at some point. And it's just a matter of, do you have the patience to kind of trade it that way? So I really think IWM is another interesting one. It's kind of in that same wheelhouse of the stuff that I'm trading along with the sectors, the Qs, and then gold as well. Okay, Wendy. So I mentioned I really like Apple still the best, especially with the price correction here on Apple. It's not the prettiest looking chart, but for the reasons I mentioned about AI, I really think that it probably is the best positioned for medium and long term. Short term, negative momentum. You might want to avoid it if you're trying to trade like a directional weekend play this weekend. Probably wouldn't recommend Apple. But for the medium and longer term, that's probably the one that's going to be more my ride or die. I still hold Nvidia. I still hold the Qs directly. But I like Apple, and I'm starting to pile into it a little more aggressively. Okay. So the next thing I want to talk about a little bit here. Well, let me ask this. First of all, any questions about just broadly where we're at? We've got about 10 minutes before my members only class kicks off. So I'm trying to move pretty quickly today. But does anyone have any questions about kind of the broad view? Okay. I don't see any. I know I'm moving quick, but let me just move on to the other topic I want to cover today, which is on the actual trade structure itself. So right now, and if you read my newsletter today, you'll hear me talk about this more. I think what you can kind of clearly say, let me just make my chart blank here so I can draw on it. I think what you kind of clearly say is that we're in a volatility-based market. Wow. Come on, Nate. You can do it. Okay. Volatility-based market, which means not directional. Now, I'm hoping that we get some direction here. That would, that's still my hope. Don't get me wrong. But I think right now we are in a volatility-based market. So what is a volatility-based market? Well, it means that the market moves more, but goes nowhere, right? And we've seen that. So the market is making bigger average moves per day. It's just really not going anywhere near as quick. So, I mean, if you think about it, if the market just turns up 0.5% per day, it's going to cover a ton of ground, right? If you had that movement a month, which you would never have, but just imagine you did 0.5% per day for a month, you'd move up like 30% by the time you compounded, because every 0.5% is actually more because it's compounding. So it would move up like 30% in a month. Well, we're not getting anything like that, and you never will, but we're getting, 2% moves in the SPY up, 1.5 down, a 4% negative move in the SPY, and then a 2 and a 3% move back up. So we're getting volatility. We're stretching the moves out, but they're just not compounding on top of each other. So how do you trade that? One thing you could do is pick a direction and just be really, really patient. That's hard, and especially if you're trading options. So the way that I've recommended trading that, two primary ways: number one, using spreads with targets, and number two, using pair trades. So I only have a couple minutes. I knew this. I knew I'd run into a block wall here pretty quickly. So today I'll cover the pair trade idea in a little bit in the next 5 minutes, because I'm going to cover the spread thing anyway for the members class at 2 o'clock. So instead of rehashing that, I'll talk about the pair trades a little bit today. And then maybe next week on Monday for our next free session, we can jump in and talk about the spreads a little bit more. If you're an automated options member, we'll talk about that anyway at 2. But for the free session, maybe a little bit more next week. So why trade? Why trade the pair trades in this environment? Well, because, to make a long story very, very short, you can get over 100% very quickly in this environment. Okay? And in a pair trade, as long as you can get over 100% on one side of the trade, then you can't lose. And in a 2%, 3% type move, you could get over 100% real quick. If any of you guys traded the IBIT calls with me, they were up like 160% in 2 days. If you did the next one on the QQQ and the IWM, any of those, they move because the market moves so much. In fact, if you would have taken a trade yesterday, just reasonably out of the money trade on a short expiration, 3 days, 5 days, whatever, today's options are up 200%, 300% in a single day. So we're in an environment where these kind of moves are happening a lot more easily on the options market. The problem is direction. Which side do you pick? Well, that's where the pair trade comes in. So the way to do this is really simple. Take one to the upside. So take a call. Okay. That can get over 100%. And then take a put that can get over 100% at the same time, and just put these together. Now, you could do this on the same asset. So you could just take the QQQ and do a straddle and just say, I'm going to take, I'm going to trade it in both directions. I don't prefer to do that. I prefer to try to work in an extra advantage where you get something that you have, a higher confidence of bullishness in, do the call on that, higher degree of bearishness, do the put on that. If you're wrong, you can still win, but if you're right, you can win even bigger. So that's my preference. And there's lots of different ways you could do that. One of the easiest ways that you can do it, you could literally just look at what's winning the day. So if you just literally say, okay, of the SPY, of the Dow, of the NQ, what's actually winning today? Okay, the Qs are stronger, or in this case, Bitcoin, which I actually really like that idea. Bitcoin stronger, we'll take that to the upside. The Dow's weaker. That's one easy way you could do it. The other thing that you could do is just a little bit of price analysis where you look, okay, what's that support? What's that resistance? What's kind of better set up to make a move, and go that direction. But the key is you want to go and buy and, well, not buy and sell, just buy options, call and put. You want to buy calls and buy puts that have the best chance of returning over 100%. Now, they don't have to return over 100% because you could have a situation where this one's plus 80% the next morning when you wake up, and this one's minus 10%. And you'll certainly take that. That's fine. But you want to give it the best potential to make over 100%, because as soon as one's up in that 100% range, then you can't lose. Now, if it goes up to 150, 180, even if this one's down 90%, you can't lose because you have over your max on the other side. So how do you do that? Well, just look at the market and what the average range has been over the last handful of days. You just literally just take like a 5-day ATR and then buy an option that could cross from in or from out of the money to in the money. Okay, so what does that mean? Well, go look at the market, and let's say that the IWM is at 225 right now, and lately it's been moving 1.5% a day. So it's been moving like $3 a day. It's at 225 right now, and you want to buy a call option. It's been moving around $3 a day. What call option would you buy? Anyone in the chat? What call option would you buy? You want it to move. You want your option to move from out of the money to in the money, and you think it could move $2 to $3. You'd buy a 227 or 228 call, right? Because if you buy a 225 call and it moves to 228, you're going to make good money, but you're going to make half as much as if you buy the 227 or the 228. Okay, so in a trade where the whole point is to get outsized returns, you want to go out and buy the ones that are going to give you that big return. Same thing if you're going to do puts, you just go backwards. I want to buy 222 puts. And so that's really the key for the profit pairs. Again, I'm obviously oversimplifying because I only had 5 minutes to kind of talk about this, but the key is to put yourself in a position where if the market moves like we expect it to move, your payoff comes really quick. Now, the other thing you want to do is you want to shorten that expiration date. So you want to shorten that expiration date down to, 4, 5, 6 days so that when you get that big move, you don't then have to wait for the option value to catch up. You want it to spike immediately so that you can close out a set of paired trades and get the maximum return on those paired trades. Now, I'm running out of time, but next, maybe Monday or the week after, we'll talk about the spreads and kind of how to use those differently, because I think that's very important, and it flips one dynamic very importantly on its head. Now, the dynamic that it flips is if you want to trade pairs and go for volatility trades, you need to give it very little time, 4, 5, 6 days. But if you want to give it time, if you want time to be on your side, do not use calls and puts, use spreads. And that's a really critical thing that I think most people don't understand, is that if you ever want to buy time, I think trading regular options is a nightmare because it's so expensive to buy time with regular options. But the way we use spreads, you can buy time on the cheap. And so that flips this dynamic as well. So those are the things that I would understand. I talk about these in my newsletter as well today. And next week, we'll dive in a little bit deeper. But understand what kind of market in. Volatility, not directional. Use pairs or use spreads. If you're trading pure volatility, use pairs and shorten up the time frame. If you are wanting to trade semi-directional, I guess I would call it, and give it more time, use spreads. Use them like kind of structure automated options, and then know exactly what you need to happen to get a win, because the worst thing that can happen is you trade the pair, you get the spike to the move up or the move down, and then you're sitting there waiting because you don't know if you've already achieved the thing. So for example, and I do have to log off here in 2 seconds, but for example, let's say the market moves down here and you say, wow, 3% move today. Time to put on a pair trade right here at the bottom. That's perfect. Put the pair trade. Now, the market spikes up here. What a lot of people do is say, oh, I'm up nice. I'm up 40% on the trade. Let me wait and see if I get more. See if I can get more on this. No. That might happen, but we're trading volatility, not direction. So when you get this move, you take that profit, because what you're playing is that there's just as good a chance that this goes back down as it goes up. So when you get the move that you're playing, take your profit. All right. And that's all I got for today. Sorry, this one was cut a little bit short. Hopefully it was still helpful for you guys. If you're automated options members, I'll see you in 1 minute in the other class. Thanks, everyone.